So Meta is up 11% in one day after their Q2 earnings. They've had a monster year. They've been doing really well over the past handful of years. We're going to look at their full analysis and see how they might do the rest of 2025 and as maybe even a long-term stock. So as you can see, Meta is up 11.25% on the 31st of July. This is right after their Q2 earnings call. So you can see the news is all about how much their shares have climbed. You've also probably seen in the news lately that they've been poaching a lot of talent from other AI companies, offering in some cases hundreds of millions of dollars, in some cases more. So they beat 22% year over year on revenue, operating income up 38% year over year, net income to EPS up 38% year over year and significantly above consensus. So advertising strength, they are up 21 to 22% year over year in advertising. They still have one of the top advertising platforms, and they have daily active users that grew up to 3.4 billion through Facebook, Instagram, WhatsApp, and Messenger. AI strategy acceleration, they invested $15 billion in AI initiatives. So capital expenditures, they spent a lot of money on data centers and AI infrastructure. Operating expenses did rise by around 12%. Notably, R&D up 23% due to AI hiring and infrastructure. Again, they've been hiring a lot of AI people from other companies as well. So basically, just to sum this up, revenues up 22%, operating income up 38%, operating margin 43%, EPS was $7.14 compared to $5.85 expected. They also had $9.76 billion in buybacks, $1.3 billion in dividends. Forecasted Q3 revenue 47.5 to 50.5 billion. So their Q3 guidance is actually quite positive. The consensus was actually 46.1 billion, and they have their own guidance between 47.5 and 50 billion. So obviously strong guidance is usually a big reason why stock prices surge kind of right after an earnings call. And of course, beating estimates on top of that. So let's look at how they've been doing other than just one really strong day. They've also had a 29% or so year-to-date return over the past full year. 62.89% is really good. In comparison, the S&P 500 is only up a little under 15% in the past year. And if you look at the last 5 years for Meta, up almost 205%. Compared to the S&P 500, which is less than half of that. Now, obviously, past performance does not equal future performance, but you look at that on top of just great numbers on revenue and EPS, plus strong guidance on top of that. It's all kind of coming together for Meta, plus the spending on the AI talent on top of that as well. And you also know that they have a lot of stability with their business model through Facebook, Instagram, WhatsApp, Messenger. They have more data. Maybe I would say like them and Google probably have more data than just about anybody on a given user. And that's also led to having billions of people using their services, but also having one of the strongest advertising platforms. And now, of course, putting all of this money into AI. So again, 28.05 PE ratio, dividend yield is 0.27%, but you're buying this mostly, of course, for the growth and not for the dividends. This is best used as probably something for younger people who may be buying for growth. Obviously, it can vary a lot by your situation. Obviously, you don't want to give financial advice. That's not what I'm doing here. But a lot of times, if you think about retirement age, a lot of people want to go into safer stocks, less growth, more dividends. This is considered more of a high growth stock, low dividends. EPS, they beat 21.82%, and on revenue they beat by 5.98%. Now if you look at some of their financials, now some of this may be updated in the coming weeks, but if you look at how they were doing year over year from March 2024 to March 2025, they were up in every single major category for the most part, and Assets versus liabilities looks really good, better than a 2-to-1 ratio there. Price to book 9.48, which is actually not too bad for a tech company if you really look at some of the others out there that they kind of compete with. 15.78% return on assets is actually pretty solid. Anything over 10% is considered pretty strong. Return on capital 18.8%. Usually 8 to 15% is considered solid, and they're above that as well. Now, if you look at the past 3 months, I also like to look at how a company is doing in the past quarter, just to get an idea of, well, how are they doing recently and not just over the course of a year or 5 years or 3 years, which are typical periods a lot of analysts would use. They're up 30.48% or 30.47% in the past quarter or in the last 3 months. And you can compare that to the S&P 500, which has also been strong, but is only up 12.63% in the past 3 months. So easily outperforming the S&P 500 all across the board through different time periods. Now they have a PE ratio that is a 25.17. Again, if you looked at the PE ratio for Google Finance, it's a 28.05. Now you might wonder, why are they different? Well, apparently Google uses more of a trailing PE ratio and Robinhood uses more of a forward PE ratio. That's why some companies have vastly different PE ratios. A lot of them are very similar to each other. But if you look at like Microsoft recently after their Q2 earnings report, where Microsoft stock went up drastically as well, they have a super high PE ratio on Google Finance and they have like a 30-something PE ratio on Robinhood. So it's like 150 on Google Finance and like 37 on Robinhood or something like that. And that's why they're different, because one is apparently more of a trailing PE ratio and the other one's more of a forward PE ratio. And sometimes the forward PE ratio can actually be more of a better indicator, but we look at multiple things here, of course, as well. The hedge funds in the past quarter in Q1 2025 were actually buying a little bit more than selling here. If you look at people who are customers of Robinhood, obviously they're going to be buying more, most likely because of their performance, but that's just over the last few days. Insiders seem to have been selling more in June and July. They might end up regretting that though. And then analyst ratings here, they have 72 analyst ratings and a consensus of an 88% buy score. Only 11% say hold and only 1.4% say to sell. So very good scores there from analysts. The consensus of 72 different analysts. You can also see how they've done on their earnings, like what they set it at and whether they overperformed or not. And they pretty much always overperformed. They've done really well and they've pretty much always beaten estimates ever since Q4 of 2023. Now, another thing you might look at as another alternative to a PE ratio, so we looked at two different PE ratios already. Well, another way that you could look at this without having to worry about tax loopholes or accounting things that are kind of tricks that some companies might use to make their earnings look better than they actually are. So this is kind of like their raw earnings. This is their earnings before interest, taxes, depreciation, and amortization compared to their EV, which is their enterprise value. This for today so far is 18.13 for Meta, which I'd say is pretty reasonable. If you look at their forward PEG ratio for NASDAQ, they have a 1.66, which is pretty reasonable as well. Normally, over 1 or like well over 1 would be overvalued. Under 1 is typically undervalued, but they're right in that kind of fair value area. A lot of them, I mean, if you look at like what analysts will tell you, they'll say under 1 is undervalued, but it's very rare that I ever see any stock under 1. But occasionally you will see some stocks that people are scared of, like Tesla or something like that, and they just have a super high PEG ratio. So it kind of lines up in some ways of whether or not it's a good price for the type of earnings growth that they are getting. You can also look at earnings per share for NASDAQ here. Based on how they've done versus expected, they've basically just been beating every single time. And analysts are raising expectations, their EPS to 5.98, whereas in Q2 it was 5.83. and also the company itself is raising expectations as well. So analysts and the company itself are both bullish on the future for Q3 of the company. And of course, I also like to look if the company seems to be a well-run organization. We know their ideas are good. We know they have that solid foundation of communication, social media apps, advertising, data, that kind of thing. Now they're really getting their hat in the ring for AI, spending on infrastructure, getting the best talent from different AI companies. But are they a well-run organization? One of the best ways to check is how do their employees view the organization? Well, they've been one of the best places to work year after year over the last few decades, according to Glassdoor. If you look at their overall reviews, a 3.8 out of 5 is actually a pretty good score. It'll say average because the average is very wide ranging for whatever reason. This seems like a really weird way to figure out an average. But on a 5-star scale, having almost a 2-point average doesn't really make sense to me. But anything around 4 stars is usually pretty good. It's a good indicator that it may be a good place to work according to employees. 66% recommend working here to a friend, so well over half do recommend working here to a friend, and more than half do approve of the CEO. I mean, it could be a little bit higher rating. He can be a controversial figure at times, but I have seen worse, and I don't think a 58 approval rating of the CEO is enough to be like, well, this isn't a buy for me. So if you factor in all of that data that we just went over, how they've been performing, how they view things going forward, how analysts view things going forward, all the metrics we just went over, I actually have them as a buy score. I've been giving out a lot of hold scores lately on different stocks, but I actually have Meta as a buy. I actually own Meta, and I've been very happy with them. I have about a 65 to 70% return over the past year from them. They are one of my favorite stocks to own right now, and I don't see them slowing down anytime soon. I think they are one of the top companies in the AI race, and they also have that solid foundation of established users with Facebook, with WhatsApp, Instagram, and Messenger. And then they have probably one of the biggest databases on people out of any company in the world, next to maybe Google or Apple. And they are always going to be one of the leaders in online advertising as well. So all of that being said, I do have them as a buy score. Obviously, I can't tell you what to do with your money. I don't know your situation. I don't know your allocation, how risky your portfolio looks right now. I actually think they're one of the more bullish stocks out there. And of course, none of this is financial advice. Please do your own research and make sure you decide based on your unique position, your unique financial situation, not somebody else's.